A committee meets in Washington and changes one number, an interest rate, by 0.25%, and within days, it reaches your credit card statement, the yield on your savings, the cost of a new car loan, even whether the company across town decides to hire. One number set in one room, quietly touching almost every dollar in your life. So what is this rate? And how does it reach so far? Last time, we kept arriving at the same place. A single interest rate the central bank sets, sitting behind money creation and behind inflation. This is that rate. And here's the surprising part. It isn't the rate on your mortgage or your card or your savings. It's the interest rate banks charge each other to borrow money overnight. Banks keep funds parked at the Federal Reserve. At the end of each day, some come up a little short and some have extra, so they lend to one another overnight to settle up. The interest on those overnight loans between banks, that is the federal funds rate. It's the one rate the Fed targets, and almost everything else takes its cue from it. And notice the word targets. The Fed doesn't simply command this rate. A committee of Fed officials sets a target range, a narrow band the rate should sit inside, usually about 0.25 point wide, and then works to keep the actual rate drifting within it. So how do you steer a rate that banks set among themselves? Mostly with two levers. The Fed pays banks interest on the reserves they park with it, so no bank will lend to another for less than it could earn, risk-free at the Fed. That sets a floor. And the Fed will lend to banks itself at a slightly higher rate, so few will pay more than that. That sets a ceiling. The market rate rides in the channel between. Why steer it at all? Because of the Fed's two jobs. Keep prices stable, that 2% inflation goal from last time, and keep employment high. This rate is the main throttle. When inflation runs hot, they raise it to cool things down. When the economy needs help, they lower it. Pull this one lever, and it reaches the rest. But how does a rate between banks reach you? Think of it as a hub with spokes running outward. The first spoke is the fastest. Your credit card? Most everyday lending is pegged to something called the prime rate. And the prime rate is simply the federal funds rate plus about 3 percentage points. Credit cards, home equity lines, many car and personal loans all sit on top of prime. So when the Fed lifts its rate by 0.25 point, prime moves the same day, and the rate on your card follows almost in lockstep. This spoke is nearly instant. The second spoke runs to your savings. When the Fed's rate is high, banks can earn more just by parking money at the Fed. So competing for your deposits, they pay you more. The yield on a high-interest savings account or a certificate of deposit tends to rise and fall right along with the federal funds rate. High rate, your savings earn more. Low rate, they earn less. The third spoke is the one that surprises people. Your mortgage? You'd think a 30-year mortgage would track the Fed's rate closely. It doesn't. Fixed mortgage rates follow the 10-year Treasury, the long-term bond market, because a lender locking money away for 30 years cares about where inflation is heading for decades, not what banks charge each other tonight. The Fed's rate nudges mortgages, but only indirectly through the bond market. The short spokes, cards, adjustable loans snap to attention. The long end moves to its own slower music. And the fourth spoke reaches something bigger than any single bill: your job. When borrowing gets more expensive, businesses take out fewer loans, delay expansions, and hire more cautiously. Households put off the financed car or the new kitchen. demand across the economy cools, which is exactly how higher rates tame inflation, but it's also how they can slow hiring down. Cheaper credit does the reverse. It greases spending and investment and firms staff up. That's this one rate reaching all the way into the job market. Here's the catch, though. The lever is powerful, but it's blunt. It works with a delay. A change can take many months to move through the economy, and it hits everything at once. The Fed can't cool one overheated corner without leaning on the whole thing. It's a single dial for an economy of 100 million households, a sledgehammer where you might wish for a scalpel. So step back and look at the machine. It was never really the Fed setting your mortgage. It's one overnight rate between banks that the Fed steers inside a band, and that rate ripples outward instantly to your credit card, through prime, to the yield on your savings, more slowly through the bond market to your mortgage, and through the cost of borrowing all the way to whether you get hired. One number rippling until it reaches your rent, your job, and your savings, which raises an uncomfortable question. If the Fed fights inflation by making borrowing expensive enough to cool the whole economy, how far is too far? Can the very cure tip the economy into a recession? What a recession actually is, and who decides when one has begun? That's next time on Monetary Mechanics. One note, this channel is here to explain how the system works. It's education, not financial advice. If it made the machine a little clearer, subscribe, and we'll keep taking money apart one piece at a time.